The Dow Jones Index just recorded its worst quarter ever in the first quarter of 2020. At the beginning of the pandemic, this was cited as a health crisis and not a financial crisis. As of now, in a move that seemed irrational to some observers, markets bounced back. The S&P 500 just booked its strongest quarter in over 20 years, as investors bet that the rebound from the sharpest economic contraction of the post-war era will keep gaining momentum despite record highs in the number of new COVID-19 cases. In this video, we analyze the effect of COVID-19 on the stock market from when the outbreak started to now life in quarantine. On the 27th of February, due to mounting worries about the coronavirus outbreak, various U.S. stock market indices, including the Nasdaq 100, the S&P 500 index, and Dow Jones, posted their sharpest fall since 2008, with the Dow falling 1,191 points, its largest one-day drop since the 2008 financial crisis. On 28 February 2020, stock markets worldwide reported their largest single-week declines since the 2008 financial crisis. Following a second week of turbulence on 6th of March, stock markets worldwide closed down, while the yields on 10-year and 30-year U.S. Treasury securities fell to new record lows under 0.7% and 1.26% respectively. After OPEC and Russia failed to agree on oil production cuts on March 5th, and Saudi Arabia and Russia both announced increases in oil production on 7th of March, oil prices fell by 25%. On the morning of the 9th of March, the S&P 500 fell 7% in 4 minutes after the exchange opened, triggering a circuit breaker to prevent stock market crashes from occurring for the first time since the financial crisis of 2007 to 8 and halting trading for 15 minutes. At the end of trading, stock markets worldwide saw massive declines, with the Dow Jones eclipsing the previous one-day decline record on 27th of February by falling 2,014 points or 7.8%. For U.S. Treasury bonds issued by the U.S. government meant to be used for governmental initiatives, the yields on 10-year and 30-year U.S. Treasury securities hit new record lows, with the 30-year securities falling below 1% for the first time in history. On 12th of March, Asia-Pacific stock markets closed down, and European stock markets closed down 11%, their worst one-day decline in history, while the Dow Jones closed an additional 10%, eclipsing the one-day record set on 9th of March. And the Nasdaq Composite was down 9.4%, and the S&P 500 was down 9.5%. And the declines activated the trading curve at the New York Stock Exchange for the second time that week. Oil prices also dropped by 8%. Overall in March, stock markets declined over 30%. Implied volatilities of equities and oil has spiked to crisis levels, and credit spreads on non-investment grade debt have widened sharply as investors reduce risk. On March 16th, with news of the coronavirus crisis extending all the way until August, the Dow Jones dropped 2,997 points, or nearly 13%, the single worst point drop on record. The CBOE Volatility Index, or VIX, is the most recognized tool to trade financial market volatility. It measures 30-day expected or forward-looking volatility of the U.S. stock market based on the S&P 500 options and rises when fear is prevalent in financial markets. The coronavirus has created such uncertainty around the world that two of the largest single-day drops in the Dow Jones have been from March of 2020. The U.S. GDP will contract by 10% with $2.14 trillion in the first 2 months of the partial COVID-19 shutdown. Meanwhile, global trade is expected to fall by 13 to 32% this year. Overall, the global GDP is to fall almost 1% this year due to COVID-19. U.S. President Donald Trump signed into law an emergency appropriations and pandemic countermeasures bill, including $8.3 billion in government spending. In addition, the Fed at an emergency meeting on Sunday evening cut its benchmark interest rate by 100 basis points to near zero and announced a $700 billion asset purchase program in order to support the flow of credit to households and businesses. The shape of the economic recovery is the single biggest factor by far for the investment community. Economists and investors have been engaged in an alphabet-centered debate over the likely shape of the recovery from the recession caused by COVID-19. The questions center on whether gross domestic product growth, plotted on the graph, would look like the letters V, that is a short, sharp recovery, as opposed to a W, representing a double-dip recession, or even a U, signaling a slow recovery. The International Monetary Fund expects that 170 countries will witness degrowth in their per capita income this year. There were projections for a V-shaped recovery for the global economy after the COVID-19 pandemic. However, the IMF's baseline scenario takes into account a partial recovery in 2021. The CARES Act is expected to cost over $2 trillion roughly, which is roughly equally to 10 cents of every dollar produced in the US in a single year. The stimulus can, in the short term, more than offset the economic hit. Many people on Wall Street point to actions from the Fed as a main driver of the market's rebound in recent weeks. Since late March, the central bank has announced a series of sweeping measures designed to help stabilize the economy, including plans to buy both investment grades and high-yield corporate bonds. The Fed's maneuvers have injected an enormous amount of liquidity in the market and restored faith of both private corporate bond buyers and equity investors that the central bank is there to back them up. This is it for our video on the effect of COVID-19 on the stock market. We hope you stay safe.